Hi, this is Bryan Crawford with Mexico Dream House at Real. Over the weekend, the big topic of conversation was the 50-year mortgage. I'm surprised at some of the vitriol and excitement around this. People are saying it's a terrible decision, but I think you really have to weigh it for yourself and figure it out. So I ran some basic numbers here that I wanted to show you. I ran a few scenarios. Number one, a 15-year mortgage, a 30-year mortgage, and a 50-year mortgage with a couple assumptions. One, purchase price $289,000. Why? Because year to date, the median purchase price in San Juan County is $289,000. Now, nationwide, the median down payment for a first-time home buyer is 9%. And then the loan amount would be $262,900. So $289,000 purchase price, $26,000 and 10 cents, or $26,010 for down payment, which brings your principal loan balance to $262,900. These are some basic assumptions. Obviously, you can run these scenarios however you want. I did not factor in closing costs, taxes and insurance, that sort of thing. PMI, I did not factor in. So let's just look at the totality of circumstances here. So right now, a 15-year mortgage is around 5.5% interest, and a 30-year fixed is around 6%. So I've seen a lot of calculations on this, and my assumption is that a 50-year mortgage will have an even higher interest rate. To be a bit conservative on this, I factored it at 6.5%. Now, this is your monthly payment difference. On a 15-year note, your monthly payment is $2,148.85. That is significantly higher than a 30-year mortgage at $1,576.76, even with the interest rate difference. Now, what you notice is the further you amortize things out, because of the way amortization schedules work, you don't actually save that much money by going with a 50-year mortgage. This is why I think it's probably not a great idea to do a 50-year mortgage. I personally prefer the 15-year mortgage. The 15-year mortgage is what I did on my first house, and that allowed a lot of financial freedom. We built equity pretty quickly. Even in a stagnant market, I sold my house for exactly what I paid for my first house. But with a 15-year mortgage, we were able to pay down our equity pretty quickly. Now, this is the payment that I keep seeing on TikTok and Instagram and Reels, is that your total interest paid. The reason I think that this is a misstep or even a red herring in the debate is that most people do not carry their loan for the duration until it completely matures. So most people will move at the 8-year mark. And so you'll see some pretty significant differences here. When you look at the total interest paid from a 15-year mortgage to a 30-year, that doubles. Even though we're looking at a half point difference, it actually doubles, more than doubles the amount of interest paid over the total life of the loan. Now, when you get out to a 50-year, and again, it more than doubles. But this is kind of linear. This is what I thought was interesting. I wanted to factor this at 8 years. Why 8 years? Because that's the normal time for a first-time home buyer to stay in their house. So total interest after 8 years with a 15-year mortgage, $92,836. $119,211 on a 30-year. Now, a 50-year fixed would be at $135,045. So your total interest paid isn't significantly different here. It's $16,000 difference. Now, that does mean a lot when you go to sell your house, but with some positive appreciation, if it brings your monthly payment where it needs to be, you're not going to be paying $300,000 more in interest unless you wait until the loan matures. Obviously, carrying a loan for 50 years, probably a mistake. Most people aren't going to do that, but 8 years, which is the duration that you're probably going to stay in the house, it's only $16,000 difference in interest. So I think that's notable. So going with a 50-year instead of a 30-year mortgage isn't as insane as a lot of people are making it out to be. Again, I don't like the 50-year mortgage, but I wanted to show you equity over time because I think this is something that's really important to know. So I did this at 10 years, 20 years, 30 years, 40 years, and 50 years, what your equity would be. This is not counting any appreciation in the market, which is something that you should factor in. Right now, we have about 5.7% equity growth year over year just based on market appreciation. So I think that's something that you should factor in your calculation. But for the sake of simplicity, I didn't factor it in here. So the 15-year mortgage, at 10 years, you have paid down that initial note that was $262,900 down $174,876. So you have paid more than half of the total principal on the loan with a 15-year mortgage. Now you go to a 30-year, it is less than half as much because you have most of the cost of the interest in the loan because the way amortization works happens in that first 5 years. So you've only paid down $68,000 in principal. That's not a huge amount. This doubles. Now, this tends to be a bit linear. Same here. With 50-year at 10 years, you've only paid it down $35,000. With market appreciation, you could still be in an equity position, but this really covers cost of sale. So basically, you're not building equity by paying down principal a whole lot. You're building equity with time and speculating on the market. Not necessarily a bad thing to do, not something I would suggest. Now, at 20 years, with a 15-year mortgage, you've been done for 5 years at that point. With a 30-year mortgage, you paid off $146,114. That would be the total pay down from this. What I thought was interesting is you've actually paid off more principal in the first 10 years with a 15-year note than you do in the first 20 years with a 30-year note. Again, this is where these numbers really start to spread, is at the 20, 30, 40-year mark. Because at 20 years, you've only paid down your principal $54,000. But in keeping with this trend, it's slightly less than you would in 10 years. Now, looking at 30 years, you've already been done for 15 years on your 15-year mortgage. Your loan has matured. You are done. Freedom at 30 years with a 30-year mortgage. Again, you're not likely to keep your mortgage for 30 full years. You're probably going to move before then, just realistically speaking. This is where the 50 year is a massive detriment, is if you're holding that loan, you've only paid down $90,000. In fact, you paid significantly more in the first 10 years on a 15-year note than you have in 30 years with a 50-year note. Now, at 40 years, you paid off $157,666. That's just what the math came to. It's not the devil's number or anything weird like that. But notice, it takes you 40 years to come close to the pay down of 10 years on a 15-year note. This 15-year note, in my opinion, is a magic formula to wealth. If, again, I did this on my first house, I bought less house than I could afford at the time, and my payment was higher. It was a little bit uncomfortable at times, but it built equity really, really fast. That's why I'm able to own the house that I have now. It's not because of my income. It's because of the equity that I made with the first house and the second house. Now, coming down here, it takes you 50 years to be done here. So if you let your loan mature completely, yes, you paid $626,000. But if you're only going to stay in your house 8 years, it costs you $16,000 in total interest to save about $90 a month. My opinion on the 50-year mortgage, I think it could work for some people. I think it's irresponsible. It's really not going to do anything to help the affordability crisis in the U.S. That's my opinion.